Good afternoon, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hope everybody had a very good day and a very beautiful weekend as well. And in today's markets, guys, well, the price action was very muted. Most of all your indexes were relatively flat over the course of the day. And that is to be expected, guys, because we are leading into one of the arguably most volatile and biggest weeks of the entire summer. And that is for two very simple reasons. Number one, undoubtedly has to be all of the earnings that we have this week. It is the biggest earnings week of the entire summer so far, and most of your major big tech names are reporting. Take a look at this. Tomorrow, AMD, Microsoft reporting after the bell. Wednesday, we have Meta, ARM, and Qualcomm with some semiconductor names right there as well. Thursday, Amazon and Apple are going to be two very big ones. So the rest of big tech is reporting this week. And obviously, guys, we have a bunch of them in between, right? We had McDonald's this morning, Semiconductor. We have MasterCard on the Wednesday morning before the open. So many large healthcare names as well. Merck, Pfizer coming in tomorrow, Procter & Gamble, one of your more consumer defensive names. And the list goes on, guys. Extremely earnings charged week this week. Should be a very nice hint at some volatility. And keep in mind, guys, all eyes are going to be on big tech this week because of how we know big tech has been quite weak in the past weeks, as we've had some rotation out of big tech and more into value-oriented names, and even small caps in the risk-on trade getting a little bit of love. The reason why everybody's paying attention to big tech, guys, is because of what we've gotten so far. I'll remind you of Netflix. Netflix had very decent earnings and then came down thereafter. Google as well last week had also very good earnings. We covered them on the channel, and somehow down another 9% after their earnings, right? Take a look at some other semiconductor names. ASML had some very decent earnings as well, and from their earnings, they're pretty much down 20%. And one of your other major semiconductors as well, TSMC, they had very good earnings and reiterated that they cannot even keep up with the current demand. Still, that is not enough. Their stock is down about 8% after their earnings. That is why, guys, even though big tech may have some very decent earnings, it all depends on the forward guidance and the forward growth outlooks. If they are not absolutely perfect with perfect guidance as well, expect potentially some continuation of the declines, which is why we've had largely muted price action today. A lot of people just sitting on the sidelines and waiting for those big tech earnings to come out. That is reason number one. Reason number two that this week is going to be the biggest one of the entire summer is because of all the macro data that we have. So take a look at this, guys. On Wednesday, the big event is obviously Jerome Powell. We are going to get to hear his stance on the economy, the jobs, the status of the jobs market, and the inflation trends, and whether or not they are satisfied with all three of those facets. Now, the first rate cut is expected to be in September. So curious to see how Jerome Powell is going to answer those questions now that the markets are pricing in a 90% likelihood of a rate cut in September. Thereafter, later on in the week, we get the non-farm payrolls jobs report, which is the largest jobs report in any single given month. So if we see some continued weakness in this number, or maybe excessive weakness in this number, that would not be a very good sign for the markets. So all of this macro and all of these earnings are going to lead into very large volatility swings this week, and we need to be prepared for it. So in today's video, guys, we're going to do a couple of things together. I do have two earnings report that I have prepared for you guys, and that is going to be McDonald's and Semiconductor, both of which came in before the bell this morning with their earnings. Thereafter, we're going to take a look at our major technical analysis rundown in terms of our major stock market indexes, see how those are standing up leading into this very volatile week. And lastly, take a look at some of the big tech names and see whether or not they are fairly priced in dip buying territory, and whether or not it could be a good idea to buy before the earnings or maybe wait until after. So that being said, guys, a lot to cover in today's video. Let's jump right into it. So SPY up about 0.06% and the QQQ's up a healthy 0.2%, but largely, guys, very mixed day of trading. Take a look at your heat map here. Yes, there was a lot of bright spots in consumer cyclical led to the upside by Amazon, Tesla, and McDonald's having very good days. But for the large part, guys, semiconductors still trailing a bit behind. The rest of big tech, very mixed. Financials, extremely mixed as well. Healthcare too, really such a mixed market today. And you can see that by the number of names that were up versus down, right? 277 names up on the SPY and 222 down. Very mixed market, nothing really moving that too much in one direction or another. Take a look at your one-day performance, guys. You can see that even better, right? Very mixed market. Consumer cyclical, communication services, real estate, and utilities are the outperformers for today. And to the downside, unfortunately, energy, technology, financials, and industrials. Very balanced, mixed market for today. Just goes to show that a lot of people are waiting on the sidelines, guys. Look at the volume on the QQQs, extremely low volume on the QQQs, and even the S&P, guys, very muted volume in relation to some of the days that we've had over the past 2 weeks. So it just goes to show you guys, everybody is waiting for big tech earnings and for the Jerome Powell speech. So before we get into more technical analysis, guys, let's jump into some earnings right away. And we're going to start it off with a bang. We are going to do McDonald's. So McDonald's actually having a nice performance after their earnings, up about 4% in the aftermarket. So moving up nicely, guys, what happened with McDonald's earnings? Well, you would be surprised. They actually didn't have very good earnings at all. That was somewhat to be expected because of the consumer discretionary spending slowdown. McDonald's has been hinting at this for the last 2 quarters in a row. And we've heard this, guys, from Pepsi, Coca-Cola, Walmart, Target, you name it, Starbucks, right? We've heard that consumers are spending less and less. Now it's time to focus on what are these companies doing to alleviate that problem? What are they trying to do to stimulate their business? The reason that McDonald's was simply up today 4% despite reporting negative earnings. Very rare double miss by McDonald's. Miss on EPS and a miss on revenue. So why is the stock up 4%, guys? Well, very simply, it was less bad than anticipated. I'm not even joking. That is what everybody's saying, just because it is less bad than anticipated. Now, I'll remind you quickly, we've been really very firm proponents of picking up some McDonald's stock in this lower location, and we'll get into that after we cover their earnings. So moving on to the headlines, guys. So McDonald's earnings, revenue miss estimates as consumer pullback worsens. Let's get into it, right? So industry traffic has declined in major markets like the US, Australia, Canada, and Germany. In several markets, we also continue to be negatively impacted by the war in the Middle East. So definitely not a great start to the earnings call, is it? These external pressures certainly weighed on our performance for the quarter, with declines in comparable sales globally and across each of our segments. But there were also factors within our control that contributed to our underperformance, most notably our value execution. They are talking about pricing. People have been complaining about pricing, and now McDonald's is finally starting to realize that they have to do something about their pricing if they want to kind of respond to the issues that they're facing right now. So company executives acknowledged that diners considered their prices too high and said that they are taking a forensic approach to evaluating value offerings and working with franchisees to make the necessary adjustments. So what are they doing? Well, let's go have a look. McDonald's same-store sales shrank 1%, missing the estimates for growth of 0.4%. So a very rare decline in volume for even a company like McDonald's. It's the first time company-wide same-store sales have fallen since the fourth quarter of 2020. In the US, McDonald's same-store sales decreased 0.7% for the quarter. Now, more consumers have cut back their restaurant spending, that we know, particularly at fast food chains, which they no longer see as a good deal. McDonald's said foot traffic to its US restaurants fell during the quarter. At the end of the day, we expect customers will continue to feel the pinch of the economy and the higher cost of living for at least the next several quarters in this very competitive landscape. This is said by the president of McDonald's, right? Very important to listen to what he just said. At least the next several quarters. So do not expect these brands to just skyrocket back, right? Yes, can we find them at good values right now? Absolutely. However, the rebound story will necessarily not be an insane V-shape over the next 30 days. It's a bit of a longer recovery play. So that being said, let's continue. Executives previously warned that the competition for customers had become more fierce as the consumer environment weakened. McDonald's is leaning into discounts to bring back diners. The chain launched a $5 meal deal late in June, 5 days before the end of the quarter. Here's what they had to say on that $5 value meal. Executives on the company's earnings call said the deal sold better than expected, with rates highest amongst lower income diners. Makes sense, right? The deal also improved brand perceptions around affordability and began to increase guest count growth, but has yet to translate into higher sales. Very, very, very interesting. Company executives said they have seen a slowdown in France due to pricing competition and consumer boycotts over the war in Gaza. Same problem that Starbucks was having as well, mind you. The company's International Development Licensed Markets Unit, which includes China and Japan, reported same-store sales declines of 1.3%. So everywhere, guys, US, international, even their Asian markets, down. McDonald's continues to be affected in several markets from the fallout of the boycotts of the brand over the Gaza conflict, and sales in China continue to struggle. So definitely not a very good quarter for McDonald's, and the president reiterating the fact that this may last for several quarters to come. However, it is McDonald's and they're very crafty with their pricing strategy. I would not be surprised as if in every single other consumer downturn over the last 30 years, they are able to manage it properly. These are veterans in the game and get through this. Now, let's dive into some of their numbers, shall we? So the numbers, guys, aren't so bad. I just want to remind you guys of how solid a company McDonald's actually is. I'm not sure if you guys know this, but even in this current landscape, McDonald's is generating in excess of 30% net margins. There is absolutely no other food or beverage company that is operating with those margins at all. If you don't believe me, have a look, right? So Chipotle, take a look at Chipotle, right? What are Chipotle's margins? 15%, very good for the industry, right? Let's have a look at Starbucks. What are Starbucks' margins? You may think that they are higher because they sell coffee, only coffee and beverages. Usually the margins are higher than those, right? Nope, not at all. Their best years, they're really generating anywhere between 14 to 15%, but on an average, about 10. Take a look at Wendy's, right? So another one that's publicly listed that we can take a look at, Wendy's, right? So this one is not Wendy's, my bad, that's Wayfair. So Wendy's, pulling it up right here. So Wendy's, you can see their net profit margins, guys, 8% at best, right? So McDonald's is really in a league of its own. They have the capacity, guys, to reduce their prices. And even if it impacts their margins ever so slightly, it probably will not matter. This is such a well-run company. Take a look at their financials, guys, right here. You can see that although they do have a substantial amount of debt that is required for the type of business that they operate in, really any quick service restaurant will have this same debt profile. Not too weird about that, but they do bring in excess of $7 to $8 billion in free cash flow per year. That is absolutely amazing. Now let's take a look at their growth, guys. Is their growth in question right now? Not really. EPS still growing very steadily. They find ways to improve on cost efficiencies using robotics and, artificial intelligence to derive better pricing strategies, depending on the region, depending on the customer, etc., right? And then in terms of their revenue as well, continuously expanding revenue. So I really don't think that there's any problem with the company at all. Let's take a look at their profit margins. Now, with their decreased foot traffic and their decreased sales, have they taken a hit where it matters the most in their margins? Well, let's take a look. That's why you pull up their financial statements. So 2024, you can see this right here, right? Here are the quarters ended right now. So you can see their net income as of this most recent quarter is still 31.15%. Absolutely crazy if you ask me. The same quarter, Q2 in 2023, their net profit margins were a lot better at about 35.5. But still, guys, anything above 30% margins for McDonald's is absolutely fantastic. Take a look at your 6-month trend as well, right? This is the 6 months ended June 30th. Take a look at this. Net profit margins 31.21 so far for 2024. Last year was higher at 33.18. So you can see, yes, McDonald's is getting slightly hit in the margins by having to reduce its prices to attract customers. However, the business is still operating excessively well. Take a look at this, guys. These are McDonald's profit margins from the last 15 years, arguably, right? You can see they've done a great job since 2015 of cutting costs, automating as many systems as they can. Look at this growth, the top graph right here. Top line gross margin expansion, beautiful. Middle graph, operating margin, right? This is pretty much revenue minus cost of goods sold. So it just goes to show they are driving the cost of goods down. That obviously stems from either automation or better supply or better contracts with their suppliers. Look at this operating margin expansion, guys, over the last roughly 10 years. It is a sight to see. And even their net profit margin expansion too since 2016, 2017. So not really since the pandemic. It started before that even. It's been ongoing for the last 6-7 years at this point. Look at this net operating margin expansion, guys. Now in the 33s. So now do you believe me that McDonald's definitely has some room to move with and that they are one of the better positioned brands in this market to deal with consumer slowdown? They definitely are. Take a look, guys, in terms of your, let's get into the valuations right now on McDonald's. Is it a very decent value proposition? Let's have a look. Well, revenue and EPS growing, very standard, right? It is a more value-oriented company, so can't really bash them for not growing these double digits per year. Now, in terms of their 2024 forward PE at $263, the current share price, it is 21.66. Now, at a first glance, it appears a little bit high, which is why we go and check their historical PE average, right? So at a forward of about 21.66 for the end of this year's fiscal earnings, we can derive that actually 21 is not that bad of a deal. It's actually streamlined with what they were kind of trading at back in 2016, 2017. Now, obviously, after and during the pandemic, they were trading a little bit higher, but now those have since compressed. So I would say that McDonald's is relatively trading at a very decent valuation right now. We can't really do the PEG ratio. I always do it anyways, but I just want you guys to focus on the fact that when you have revenue and EPS not growing double digits, right? So this is no longer a growth company. It's more a value and defensive company, right? So that's why we can't really use the PEG ratio. It doesn't paint the best picture of whether or not the company is fairly valued. Usually we would use historical PE averages when we don't see EPS growth above 10% for the foreseeable future. That being said, we can also use something called the free cash flow yield. That is very, very simple, guys. It's just the amount of free cash flow that they bring in per year, and then you divide that by their market cap. It just goes to show when you buy one share of McDonald's, how much of that share is pure free cash flow that the company can use to do dividends or buy back shares, which helps you in the end. Very widely used metric in the industry. Usually the standard that we're looking for when companies are at a good, attractive deal, especially these legacy companies, you want to see free cash flow yields anywhere between 3.5% to 5%. That's usually when a company is at a good discount. When a company like McDonald's or several others, right, like, I can bring up many others, whether it's say like a Procter & Gamble or a Visa or a MasterCard, stuff like that. When those are pushing all-time highs and valuation gets a bit stressed, you will see that free cash flow yields are usually about 2.5, 2.7%. That's when you know, okay, it's slightly overvalued. But for McDonald's, trading at a 21.66 forward PE and a free cash flow yield of 3.85, very decent. Couple that with the technicals right now, guys. Technicals are looking absolutely gorgeous on this company, tagging the 50 monthly EMA. McDonald's usually never tags the 50 EMA for too long. This was COVID, so we'll kind of dumb that down to an anomaly. The last time they did it was in 2015. You can see it's always a good value proposition for the long term, right? This is not NVIDIA. So this one can take a little bit of time to recover and get through this consumer cyclicality that we're having right now in terms of spending. So it can take some time, guys, but it has always been a great value proposition buying it at the moving average, the 50 MA on the monthly. Couple that with the weekly 200 moving average, this green line right here. Except for COVID, they touched it once or twice back in 2014 and 2015. And you can see history pretty much paints the rest of the picture, right? So it can take a little bit of time for it to recover, but usually buying in these levels right here represents a very good value proposition. And I still do maintain, guys, McDonald's, have to give it to them anywhere $260 down to about $245, guys. I would be buying this one for a long-term portfolio position, no problem at all. And even a little bit of a swing trade, guys, right? If we were to take maybe a retest of these mid 250 levels, 255, very easy trade. Just set a stop loss right below here, 243. We're pretty much having about $12 worth of risk. And the upside is quite decent here, guys, right? Targeting pretty much your 275 and then all the way back to the all-time highs, 290. So very decent risk to reward profile for even a little bit of a swing trade over the next few weeks or maybe a month and a half. So long-term investment, yes, and swing trade as well, definite yes from me. That's pretty much everything for McDonald's. Now let's get into company number 2. We're going to be covering ON Semiconductor. Give me a quick second. And let's get right into it. So ON Semiconductor, guys, one of your other semiconductor plays that had earnings this week. The other ones are, of course, AMD, and then we have a big one, Lam Research, coming in with ARM and Qualcomm on the Wednesday session, of course. ON Semiconductor, though, at least gives us a first glimpse into how the week might go. This one, however, I have to give you guys a little bit of a backstory, okay? So this one, the reason that it's been down pretty much since midpoint of 2023 is because 65% of the revenue is pretty much the automotive industry. They manufacture a bunch of semiconductor chips and sensors for electric vehicles, more specifically. Yes, for other cars, of course, but a large part of their business segment is now catering to electric vehicles, right? So that is why, because the auto industry has been in a little bit of a drawdown, that's why ON Semiconductor as well has been in a little bit of a drawdown. So hopefully that one makes sense. Let's go see what happened with their earnings to warrant such a beautiful boost today by about 11.5%. Well, they had a double beat on EPS and beat on revenue as well. Now, that's never been a problem for them, even though this year they did say all throughout the year it was going to be a bit of a transition year for them as the auto industry kind of bottoms out and regains to growth later on in the second half of this year and into 2025. Their guidance for the next 3 years is quite good. Look at this EPS expansion graph, relatively good, and revenue expansion graph, relatively good. After this 2024 right here, a little bit of a transition year, right? So let's get into the gist of things and explain why they're up so substantially after a move like today. Well, let's have a look. So last month, the company unveiled silicon carbide chips which have two applications. First, they're designed to make data centers more energy efficient by improving power conversion. So attacking the ever so hot data center business, right? Obviously put on by NVIDIA and now replicated by so many others, but just to say they are attacking this line of business as well. Second, silicon carbide chips are used in electric vehicles to extend their driving range. Although silicon carbide is more expensive than standard silicon, its superior performance in both energy efficiency and range makes it a valuable technology. Here's what the CEO had to say about this. As reflected by our recent supply agreement with Volkswagen Group, we also continue to strengthen our silicon carbide leadership position in automotive as we ramp production with leading global original equipment manufacturers in Europe, North America, and China. Suffice it to say, guys, they have partnerships all throughout the industry. Pretty much 85% of all car manufacturers, guys, use ON Semiconductor chips or sensors. Now, let's move on. Third quarter outlook. So we just had Q2. This is the outlook for Q3. After a prolonged period of weak demand for automotive semiconductors, car makers are now clearing out excess chips inventories built during the pandemic. This is likely to benefit companies like ON Semi because as car makers deplete their old stockpiles, they will need to purchase new chips. ON Semi, with its advanced semiconductor technology, is well positioned to supply these new orders, thus benefiting from the rebound in chip demand. And we've been hearing this, guys, pretty much across the board from semiconductors, whether or not they're exposed to autos or whether or not they're exposed to cloud computing or data centers. 2024 is going to be largely a transition year for many of these companies for the reason that ON Semiconductor just stated pretty much. There was so much excess inventory built up during and after the pandemic that a lot of manufacturers are still working through that inventory, right? We've heard it time and time again from many different companies. Lam Research has come out and said this. TSMC has hinted at this, even though they said the demand was fairly robust. ASML has said pretty much likely the same thing too. So we've been really hearing it all across the board. So it should come as no surprise that 2024, even though for stock prices of semiconductors have been very good, in terms of overall demand and growth, 2024 is relatively flat versus 2023. The boom years are really 2025, 26, and onwards. And that is what everybody has said in the entire industry, whether it's NVIDIA, TSM, or ASML, right? Your industry leaders, for the large part, Broadcom as well. They've all been saying the exact same thing. Now let's get into a few of their numbers, guys. So in terms of their numbers, guys, you can see down here, I just want to show that pretty much everything is down on a year-over-year comparison. That is completely normal, as we just saw the charts, right? Don't get nervous by these charts. 22 and 23 were blowout years for the company. Now we will be down sequentially, but growth will be resuming next year onwards. So we're trying to time the bottom of these semiconductor names that are or that have been affected by this cyclicality, and appears as though we are pretty much bottoming out as per the CEO and management's comments. So looking forward to seeing what ON Semiconductor delivers, right? So automotive down 15% year over year, industrial down 23% year over year, and the other revenue is down 15% year over year. But you can see a majority of the revenue, 65% roughly, is due to automotives. Now let's go into it a little bit further, shall we? So moving on into it, guys, not going to cover everything, but just want to say that these guys are exposed to everything that's going to be a hot topic in the next 5 to 10 years. Energy infrastructure, they do that as well. Look at the compound annual growth rates of each one of these industries. They are providing technology for charging stations as well. Battery automation, which is going to be very big in the next 5-10 years. EVs, advanced safety. They're talking about sensors, whether it's camera sensors or pretty much, your automated cruise control sensors that a lot of cars use as well. So many sensors go into cars right now, and ON Semiconductor has a commanding market share of all of them. 15% compound annual. And then obviously you have your 5G and cloud power, which is a very big market share for them, right? So they are the #1 position in automotive and industrial applications as a whole. And they have a 68% market share in ADAS. That is advanced driving assisted systems, right? So talking about that highway lane management, automated cruise control, and good stuff like that, right? So moving on down, guys, you can see all the sensors that they make for different cars. It's not just the to cameras, it's so much else in the entire industry. Here's a list of all the people that they're partnered with as well as pretty much, as I said, 85% of all of the car manufacturers in the game right now. Here is their long-term targets. I want to pay special attention to these long-term targets because we're looking to pick the bottoms of monthly consolidation ranges and looking for potential multi-year expansion. Do they have the markets required for multi-year expansion? Let's have a look, guys. This is their 2027 target, and these are all very based on relatively, I would say moderate models. They're not being too bullish, they're not being too bearish, right? So revenue should be growing at about 10-12% compound annual growth rate. Very good. They should be improving their gross margins from 47 to 53%. Very good. Reducing operating expenses over the long term from 14.8 to about 13. Operating margin will see a nice boost as a byproduct of growing revenues, reducing expenses. That means your operating margins will go up. They're targeting 40%. Capital expenditures, they want to spend less and less. Obviously, this makes sense. Capital expenditures, guys, is pretty much what you pay for building out factories, purchasing robots, equipment to manufacture your products, right? So they're scaling up and ramping up now, but that is not going to last forever. That will be coming down over the next couple of years from 19.1% of revenue all the way down to about 11%. Very good. And they will be improving as a result of the lower spend in CapEx and the improved margins. They will be bringing on more and more free cash flow from 5% of revenues all the way up to 25 to 30%. So very good long-term guidance for the company. That's why I felt it necessary to share this, right? Now, in terms of the valuation of the company after this most recent earnings, so let's have a look here, right? So they are growing earnings, they're growing revenue 10% per year, which is very decent. And EPS growth, well, since you guys will see 2024 is a little bit of a down year, right? So a little bit of a down year in 2024, but I like to look at beyond the down year for their growth. That's why I have two numbers right here. If we were to include the down year, it's only 8% per year with 2024, but thereafter it is 18%. So in terms of the PE and the PEG ratios, right? The forward PE at $78 is about a 19.5. Not that expensive at all as just a nominal figure. But when we divide this by the EPS growth rate, which gives us the price to earnings growth ratio, that is now sitting, if we take 8%, it's sitting at about 2.43, which seems a little bit rich, right? But that's why we need to respect their long-term growth forecasts as well, as the auto industry will be bouncing back after interest rates decline and demand gets stimulated again. Obviously, it takes a long time for that to come, right? Doesn't happen in 2 weeks, but over the next 6 to 9 months, that cyclical bottom and uptrend will start to be felt in these stocks, and the share price should react accordingly. Now, if we take their 18% growth, they are only sitting at a 1.08 peg on a 2025 forward basis. This is very cheap for the long-term vision of the company. Looking very good on the technicals, guys. You guys know this. We've been playing this one on the channel for a better part of the last 6-7 months in the mid 60 to low $60 range. I really like this base of support, guys, right? Even after such a big cyclical drawdown, the bears have not been able to get through this one. So at this point, I really don't believe that they will be able to get through this one since the business is now bottoming out and resuming course to the upside. So looking very good for some resumption to the upside. ON Semiconductor, of course, popping. So may just be looking for the eventual daily higher low for potentially daily uptrend. We need to pay special attention, guys. Yes, this company performed very well today. However, they can be affected by the rest of semiconductor earnings coming out this week. So just be mindful of that. This is why I'll still be very patient with this one. If it does come back and pick me up, guys, I really like it, guys. 71 all the way down to about $65. I really don't think you can go wrong with this company, either for a short-term swing trade looking to just gain back the levels when semiconductors get more, when semiconductors come out of their weekly consolidation and monthly consolidation that they've been in now for about 2 weeks. So could be a good little swing trade for the next couple of months, or a decent long-term investment if this is a type of company that interests you. So that's pretty much everything for ON Semiconductor. Now let's get into our technical analysis portion of the video, shall we? We're going to be going through the indexes. Give me another quick second. All right, so moving into the SPY. So moving into the SPY, guys, right away, 0.06% to the upside, not that much. And I'll be the first to say, guys, that price action this week is going to be fairly difficult to derive. just because of how many things we have. We have the Federal Reserve and we have all of these earnings, right? So even if we understand that the short-term bears are in control of this daily downtrend, if earnings are very well received, starting with Microsoft tomorrow, we could get an excessively green bounce. And even if thereafter, if Jerome Powell is nice to us and we get nice earnings from Meta, MasterCard, ARM, and Qualcomm as well, then we may be able to carry this one higher and the bulls may be able to get a chance to reset this into a daily uptrend. However, if the flip side is true, if earnings are not well received and Jerome Powell has a fairly hawkish tone with us, I would not be surprised if we resume with who's in control, and that is undoubtedly the bears right now. So pure price action. If we remove all the earnings catalysts and Jerome Powell and the jobs report, right? The bears are still in full control of this daily downtrend right now on the SPY. Take a look at the size of the bounce. The size of the bounce by the bulls is not too bad, about 50%, but it's definitely not a 618. If we can bounce up at least to 550 after tomorrow or into the Wednesday session, then the bulls will have created enough space to potentially reset into a daily high or low using this green box, right? Look at this green box, prior support. Now it's acting as resistance because we're pulling into it, but those good earnings could really push us above, and then we may have a very good chance at resetting this into a daily uptrend. However, if the earnings are not well received, guys, you guys know the drill, may just be revisiting the bottoms and lower lows and continue this weekly consolidation, which may just bring us into, guys, our big level of support on the SPY, which would be 531 down to about 516. That would be a total sell-off top to bottom of anywhere between 6 to about 8.5%, which is largely the same thing we got back in the month of April, almost 6%. And last October into the fall, we got about 10% on the SPY. So those numbers would really be within our recent averages, and that's to the maximum that I'm expecting. Moving into the QQQs right now, QQQs, same boat as the SPY. Daily downtrend is clear as day. The bulls have made a somewhat of a bounce attempt, but we have to be mindful, guys. There is a few areas above us acting as resistance. Obviously, this is the first one, prior support for the markets, and now going to be acting as overhead resistance. Couple that with the fact that most of your moving averages are now above us as well, the 50, the 12, and the 26. So moving into this, guys, right, if we were to remove all the earnings and Powell, I would still just be looking for a lower high, and then it's up to the bulls, guys, depending on the size of the bounce and the location of that lower high. Can they create enough space to be able to set a daily high or low and reset the daily uptrend? The reason space is so important, guys, is because if they don't put in, look how weak this bounce is right now, right? Very, very weak bounce, as a matter of fact. Take this on the fibs, right? From top to bottom, you can see the bounce is barely 38.2%. The bears still have momentum down here. If the bulls put in an 100% engulfing move, do you guys think it's easier for the bears to do this, or is it harder? Well, it's obviously harder because they have to cover so much more ground, right? If they wanted to flush this level, would it not be easier for them to flush it from here rather than from all the way up here? Right? That is why the size of the bounce matters so much, which is why I say if the bulls take back 61.8%, which is your golden ratio on the fib, which would be about 474, if they can get it all the way up to here, guys, it gives them a good chance. It creates a lot of space for then when the bears make their attempt, they don't have enough momentum anymore, and the bulls just overpower them and reset into a daily uptrend. So hopefully that makes sense, guys. But as of now, daily bears are in full control. If earnings, you guys know the drill, earnings are good, we can get a nice bounce, reset for the daily uptrend, and the sell-off will be over. However, if we get bad earnings, guys, expect this daily downtrend to continue into further weekly consolidation, which could bring us into these following levels. 450 all the way down to about 435 at the lows. That will be a top to bottom sell-off. 10 all the way down to 13%, largely the same that we got last April was about 8%, and this one back in last fall was about 11%. So this region right here could also represent a decent value location for buying the dip more aggressively. Now, moving into XLF Healthcare, give me another quick second. Sorry, guys, pretty thirsty today. I don't know why. It's very, very hot up here in Montreal. So moving into XLF financials, guys. So 0.14% to the downside is financials, but as a whole, they are holding up very strong. So daily uptrend, moving into a daily downtrend. We knew what we were looking for, guys. We were looking for a potential weekly higher low, but we never really got the chance to form it too much, right? It was just a very quick daily downtrend, engulfing move by the bulls, looking very good. Now we will be looking to attack the all-time highs at about 44.12. If ever they fail, they do have a decent amount of space to set up for a daily higher low for the potential daily trend change, and just looking for the extension of this weekly trend higher. However, if we do start a little bit of a reversal pattern and lose this again and start challenging these lower locations right here, prior resistance, current support for the bulls, 42 down to about, well, 42 and a half down to about 42. That could be the start of some potentially larger weekly consolidation, right? Then we're just going to be looking for a weekly higher low for continuation of the weekly uptrend. I would not be too nervous about financials this year at all, especially coming into a rate declining cycle. They should be very, very favored. As of now, though, the bulls are still in control. So nice to see, guys, that even though the QQQs have been getting hit the hardest, what has been making up for it? This is why rotation is so important. Well, the other two major sectors of this market, XLF and XLV, have been holding up the SPY, which means that yes, even though the SPY is down 5%, guys, you can imagine it would be a whole lot worse if our two other biggest sectors, financials and healthcare, were down as well, right? The SPY would be down 8, 9, 10% right now. So we have to give it to them. Moving into XLV. So XLV also performing very nicely today, right? Still the context of this very nice daily uptrend, still just hunting for higher highs, which would be a break of 150, 155 that we know. However, if the bulls ever falter and show a little bit of weakness, guys, the daily higher lows are pretty far away. Anything above 147.12, just gonna be looking for a daily higher low, maybe a little bit of extended consolidation, and then looking for that bullish bias lean. Why do we have a bullish bias lean, guys? Monthly uptrend is looking absolutely gorgeous, which is why I think that any extended daily consolidation should result in a bull break. You can see that on the weekly as well. Gorgeous weekly uptrend, and now we have the weekly breakout. So even if we do a little bit more consolidation here above the all-time highs, above this big range of support right there, just looking for a weekly higher low for potential continuation of the trend expansion, with that monthly trend expansion really leading the way, right? So long-term looking very good, and even the short-term bulls are in full control. Now, moving into SMH. So SMH down again on the day, 0.71%. That is absolutely normal, guys, right? Just have not been having the best time at all. Rotation out of semiconductors, a lot of anxiety and anticipation leading into these earnings this week, because you guys saw what happened with ASML and TSMC. They had very good earnings and then still went down. So people are obviously being very timid on semiconductors with good reason, right? This index has ran substantially. I keep telling people, like, what more do you want, right? We hit monthly overbought conditions. We were hitting continuous weekly overbought conditions. This one has run a ton in the last 9 months, outperforming everybody. So you have to give them a little bit of a break when they try to set up for the monthly higher lows to eventually continue that trend. They need to consolidate at a certain point, guys. It's just healthy market price action, right? That being said, we're not yet in daily oversold, and the bears do control this time frame right now. So potentially looking for the revisit of the daily lower lows. That will all be dependent largely on the earnings coming out this week. AMD, ARM, Qualcomm, and Lam Research, just to name a few. They are pretty much your largest, some of your largest components by weight in this index right here, right? You can see AMD, Qualcomm, two of the biggest right there, and the other ones are right down below. So moving in, guys, the bounce, not juicy enough. We were looking for a decent sized bounce in relation to 258, and the size of the bounce was just not the best, right? Bounce size barely getting up to about 50%. That's decent, but it's not the 618 or higher, which is what we need to give the bulls the best chance at resetting this into a daily uptrend and putting an end to the weekly consolidation. As of now, weekly consolidation simply continues with this big move. However, we are coming into a decent level of support, 238 down to 224. So very curious to see how we are going to react from this zone, whether or not we just blast through it or whether or not we are able to then get a nice bounce going from there and maybe set up the bulls for a weekly trend recapture leading into the later part of August and maybe even early September as well. As a whole, though, guys, you guys know the drill, right? Short-term bears are in control, but who's in control of longer-term timeframes, guys? Complete bull control on the monthly. The weekly looking a little bit dicey right now, but could just be case in point for some extended consolidation before recapturing that uptrend. So that's pretty much everything for your SMH. Now, moving into IWM Russell. So IWM Russell down about 1.1% today. Not the best day at all, right? But however, where are we consolidating, guys? We're consolidating around the top end of the move, which is not too bad. Where is the Russell getting rejected? Well, very simply, guys, we're getting rejected from one of the biggest resistance areas that the Russell has ever faced. Very, very difficult for the Russell to just blast through this when the indexes are just waiting on the sidelines for Jerome Powell and for earnings, right? They cannot do everything themselves. So encountering a little bit of long form resistance up here. So if ever the bulls cannot get this breakout beyond this level done, and if ever we start losing this daily time frame into a daily downtrend rollover, you guys know the drill. On the weekly, gonna just be looking for that weekly higher low for a potential second attempt at this trend shift. That being said, I will be patient and waiting for this area right here. 210 down to 207 is where I really want to take this trade myself, looking for the breakout, retest of the range, and run. I'm just waiting for confirmation, guys. I am not trying to chase this one up here at all. And even on the monthly, guys, you see it. Monthly breakout is nice, but maybe a potential monthly retest in the month of August before trying and attacking this huge level of consolidation above us. So the Russell, not looking too bad, guys, but I would not be surprised if the markets continue their consolidation, if the Russell gets dragged down as well, and I will be patiently waiting to shop a bit for it down here. Now, moving into the Dow Jones. The Dow Jones down about 0.12%, but not too bad, right? This one is really identical to XLF. Look at this price action, right? Between this and the Dow Jones. It looks pretty much almost identical, even though financials don't represent the largest weights in the Dow Jones, still pretty funny, right? So daily uptrend was nice and they lost it just like financials. Now engulfing move, right? 100% of this most recent leg of selling was engulfed. It creates enough space for the bulls to either push this higher and reset into a daily uptrend, or even if they falter from here, decent amount of space, anything above 39,800, just gonna be looking for that daily higher low for continuation of the daily uptrend. Now keep in mind, guys, we do have nice areas of prior resistance, which is now going to be support below us. And we do have a very nice weekly uptrend in motion. So even if the bulls were to lose this location right here and consolidate with the rest of the markets, if Powell is hawkish and earnings are bad, you guys know the drill, just hunting for a weekly higher low, anything above this level, guys. So much space for a weekly higher low for continuation of the uptrend. That's pretty much everything in terms of our major stock market indexes. Now let's dive into some of our big tech names, shall we? So taking a look at Apple first, guys, in terms of our big tech names, you will see that Apple is indeed green on the day, but barely 0.13%, right? So daily downtrend does simply continue at this point. We may be looking for a short-term bounce, but any short-term bounce, guys, should just be for a lower high and then maybe looking to continue the trend downwards. Of course, guys, this doesn't really matter because we have earnings for Apple on the Thursday session. So let's have a look in terms of the expected move for earnings. How much can they move? You can see I have it up on screen right now. For Apple, you can see the expected move, 227, about 4% up or down from current trading price right now, 227 to the upside and 209. So if ever we get to 227, guys, that will likely engulf this move right here, give the bulls enough space to reset that beautiful daily uptrend and maybe put an end to our weekly consolidation, right? Weekly higher lows and potentially just the resumption of the weekly uptrend. However, if we hit the lower side of the expected move around the 209 location, well, then things are going to get very, very challenging for the bulls, guys, because although this will still be looking for a weekly lower high, you guys know the drill, right? It's all about the size of the move, right? And in this case, the bears, if we come down all the way to back to 209, will have taken back roughly over 80% of the move. When the bears take back 80% of a move, guys, it's extremely difficult for the bulls to just do this, right? Same reasons as we explained prior in the video. If they take back 80% of the move, the bulls have no more momentum, right, to really do something like this. At best, we can maybe expect potentially a tightening range. That's the best case scenario. And in the worst case scenario, we might expect a little bit of a weekly rollover into further monthly consolidation after 3 months of gorgeous rally. If Apple does choose to pull down and consolidate into the month of August, we may just be revisiting these lower levels down here, which is where I want to really buy the stock more aggressively. 205 down to about 200 is my desired price target, simply because it is the prior all-time high resistance level. That could be a very nice level for a retest. You really see it best on the monthly, guys. Breakout on the monthly, retest of the all-time highs, and maybe run. So at these current valuations, guys, Apple, we did them. We'll do them after these earnings as well. But right now at about 214, 3.08 peg ratio, little bit too rich for me. That's why I'm really not touching this one up here. I will wait for after earnings. If we do consolidate a bit more, 205 down to 200 is my desired location. Moving into AMD right now. So AMD also down on the day by about 0.17%. Now, AMD has been no stranger to the most recent sell-off, right? They are down an absolute ton, down about 25%. But in my humble opinion, guys, with such a large drawdown leading into earnings, they are really going to have to miss earnings hard for them to really get a bad beat off of earnings. That's it, just in my opinion. Obviously, anything could happen, right? However, in terms of the price action, we obviously know that the bears are in full short-term control, and any bounce will just most likely be looking for a lower high, and then depending on the size of the bounce, it'll be up to the bulls to be able to reset this into a daily uptrend. However, as we know, guys, that really doesn't matter. AMD has earnings tomorrow after the close, so let's take a look at the expected move on AMD together, shall we? And potentially derive some levels for some entries that we're interested in. So the expected move is 8% up or down. Obviously, it can go more, it can go less, but let's just say it's 8%. Top line, 151, bottom, 128. So in the event that we really move to the expected move to the high side or better, that would be a very decent bounce, guys. If we get above 150, that would be a very, very decent bounce. It would give the bulls about a over 618% retracement, which would set them up for a potential daily higher low and the recapture of the daily uptrend. I will be looking, if that's the case, I'll be looking to play the daily higher low after the earnings move is done, a little bit of reset, and then we're going to be looking to run. Entry is here, stop loss is below here, and then we're really targeting up heads of this resistance level right there. So decent little trade setup if earnings are bullish. Now, in the event that earnings are bearish and we just continue this slide on the daily, continue this slide as well on the weekly, at that point, guys, if earnings are bearish, we are already in daily oversold conditions. If we get an earnings disaster tomorrow after the close, guys, it will be daily heavy oversold conditions. And if ever we end towards the low side of things, talking about maybe the 129s, the bottom end of this location right here, it will open up short puts in the 120 all the way maybe down to about the 115 area. This little pocket, 120 to 115, is exactly where I want to be playing this one. Valuation, if we come all the way down there, the PEG ratio, guys, will be sitting close to a 1.1, 1.05. That will be extremely attractive. My entire zone that I'm looking for, guys, is down here, right? 120 down to about 115, start of this big support range that we had pretty much back last year. Those are going to be the ones that I will be looking to make the trade on AMZN. So those are the two probable scenarios after earnings, guys. Obviously, if the stock does absolutely nothing after earnings, I still do believe that this area represents a decent buying opportunity, but I will be waiting for earnings on this one. Hopefully that makes sense. Moving on, guys, tackling Amazon right now. So Amazon up about 0.38%, not looking too bad, right? But obviously this is another company that has earnings coming up this week, and they have earnings more specifically on the Thursday session. So a couple days left of trading, and this one will obviously be heavily impacted by earnings results tomorrow from Microsoft and the ones after the close, Meta on the Wednesday. They could be dragged up or dragged down in the process, right? That being said, the bears are in full short-term control right now. We have a decent little bounce going right now. The bulls are trying to set up for a daily trend recapture right now. That being said, if Amazon dips a little bit lower, let's take a look at the expected move and derive some levels that we can maybe take some trades after those earnings on Thursday. Obviously, guys, we're going to be doing this a lot during the week, but at a first glance, just want to give you guys the context, right? So 170 to the downside and about 196 to the upside. 7% expected move. That's fairly large for Amazon. So in the event that we come to the downside towards the 170, well, look here, guys. Where's the 170? Well, it just so happens to be in this huge area of prior all-time high resistance, which is now going to be very heavy support by the bulls. And you can see it's already acted as heavy support for the bulls this entire year, ever since the month of March, since we've gone through it, right? So that would be a very juicy opportunity to go shopping for some Amazon. If we do pull back in the lower 170s, I'll probably be buying some shares, and in the trading account, probably writing some short puts ever so slightly below that, guys, maybe towards the mid 160s, even 167.50. I would not be opposed. And then obviously, guys, well, if ever the earnings hit to the upside and we go all the way back to 195, well, no problem, guys. We will just be resumption of the weekly uptrend right there, and everything's going to be looking absolutely gorgeous, right? So at that point, going to be very patient for earnings, not really going to take many positions on Amazon prior to earnings. I will probably be playing the earnings call on this one with short puts, and I will be targeting below 170 for those short puts because I actually want the shares down there. Moving into Google right now. So Google does not have earnings this week. They had them last week, looking pretty good, 1.45% bounce this today, right? So daily downtrend clear as day. Now we're on the watch for the size of the bounce, but pay special attention. This whole area that used to be support for the bulls is now acting as resistance as we're pulling into it. All the moving averages are now above us as well. This has not been the case, guys, ever since pretty much the month of February, where we went slightly under it, right? So we have to acknowledge the fact that we are coming into resistance. That being said, the bounce size right now, nothing to cry home about, right? Only about a 30% bounce. I would really need to see this one bounce at least as high as 177 to give the bulls the best chance at getting this daily uptrend reversal in motion. That being said, this trade is obviously beholden to the rest of big tech earnings this week. Now, if ever Amazon gets dragged down, or Google rather, if ever Google gets dragged down by the rest of big tech earnings, and we start to visit these lower areas, guys, think of the prior earnings gap fill location, 161 all the way down to about 158. that is going to be a super juicy location in my humble opinion. 200-day moving average is right there as well. And at that point, Google would be pretty much trading 16 to about 18% off of its recent highs. In the context of bull markets, that's usually been a very attractive location to buy Google. 13% dip right there. The rest is history. Very nice dip right here. 13%. This was pretty much last fall, right? And beautiful recovery thereafter. Anytime Google has a relatively large dip, anywhere in excess of 12 to 16% in recent history of bull markets, it's usually been a very decent buying opportunity. And trust me, guys, we went over the earnings on the channel. This company is firing on all cylinders. I saw no red flags to warrant anything like a 25-30% sell-off, right? So I have started nibbling on Google, but suffice to say, if it comes down even lower into the mid 160s, low 160s, I will be buying even more aggressively. Now, let's take a look at Meta. So Meta, flat on the day, literally flat on the day. It's been a long time since I've seen a 0% change day on Meta. That being said, who is in control right now? Well, undoubtedly, guys, it has to be the daily bears, right? Daily bears in full control right now. We were looking for the size of the bounce, and so far the size of the bounce is quite decent, right? A 618 bounce to the dot. So they have created enough space to potentially set up for the daily higher low and for that trend change, right? Now, if there was no earnings, I would say that the bulls would have a very good chance at resetting this, especially since we're respecting the blocks of support that we're currently consolidating into, right? Got rejected here at the bottom of it. Now we're trying to use it as our last line of defense and rise. However, Meta has earnings, of course, on the Wednesday session. So let's take a look at what the possible swings can be on Meta stock. All right, so take a look at Meta right now. So you can see 9.3% expected move. That's higher than usual, guys. Usually Meta only has about a 6-7% expected move. To see them at 9.3 just is a testament to how volatile this week could be with most recent tech sell-offs and Jerome Powell, right? So 9.3%, that is huge for Meta. 509 to the upside and 422 to the downside. So let's take a look at the downside expectations, guys. 422 would pretty much put us at the bottom of last earnings cycle as well, would put us below the 200-day moving average, which has not happened, guys, since the Meta rally started February of 2023. So that would definitely be significant if we lose the 200-day moving average. 420, however, would represent a heck of a buying opportunity, guys. I love this area, and I bid it last time we came down there. I bid it, and I was handsomely rewarded thereafter. So if ever we do dip down, 420 down to about 395, guys, the valuation on this company is going to be amazing. Already at $500, we're significantly under that right now. At 500, the peg was about a 1.23. Now, from 500, right, how much are they down? Roughly, let's call it about 7%, right? So this ratio right here should be closer to about a 1.15, closer. If we come down all the way down here, 420, that should be closer to pretty much a 1 peg, which is outstanding value for such a strong company. And the free cash flow yield, if we come down there, guys, that'll be above 4. Both of the metrics, whether you're value metric oriented or growth metric oriented, everything is pointing towards the fact that down there, Meta would be significantly undervalued. So that would be case in point. If ever we drop in that location right there, I am definitely buying. I've already started buying Meta a little bit up here, but if we come down into there, I will buy even more aggressively. And obviously, if they smash it to the upside, 509 or better to the upside, well, your bulls will have completed a complete engulfing move to the upside, creating enough space to reset this into a gorgeous daily uptrend. We'll be back above the moving averages, back above this big range of support, and we can then use it to establish a daily higher low and reset this and get us back into a potential weekly uptrending motion, right? So those are going to be two of the main things to watch out on for Meta either way. So hopefully that makes sense as well. Moving on to Microsoft right now. So Microsoft up about 0.34%, and Microsoft, guys, still in the context of a daily downtrend as well. Let's take a look at the size of the bounce, right? Size of the bounce as per now is okay. It got all the way up to about 50% before retracing a little bit today. But obviously, guys, we know the daily bears are in control. We know we're in weekly consolidation and a weekly uptrend. However, we have earnings tomorrow on Microsoft after the close. So let's take a look at Microsoft. Usually Microsoft, in my experience, has an expected move 3.5%, 4%. Let's take a look. So Microsoft this week, 4.7%, a little bit higher than traditionally. That being said, the expected move to the downside, 407, to the upside, 447. So let's take a look. 407 to the downside, guys. 407 to the downside would literally put us exactly where I want to buy Microsoft more aggressively. The lower range of this whole support bound, right? So 407, I would not be opposed if we do come down there. 407 down to 400, screaming buy for Microsoft. The 200-day moving average is right there as well. We haven't lost this one as well since March of 2023 when we started this entire bull market. So should be a fairly decent area for a dip. If we do come down into there, guys, that will be a sell-off on Microsoft of about 13, 14%. And usually look at all these sell-offs, guys. 10 to 14% has usually been an extremely attractive buying opportunity for Microsoft when we go back in the context of overall bull markets. Look at every single one of these dips. If you see 10 to 14% on Microsoft, it is a good quality name to be buying on a dip. So as of now, I have been buying a little bit of Microsoft right here, but if it drops even more towards a more sturdy support level down here, towards the 200-day moving average, I will be buying it a little bit more heavy. So hopefully that makes sense for Microsoft to the downside. If ever they blast through the top of this one, 447, well, you guys know the drill. 447 is all the way up here. That is pretty much your most recent high, lower high. So that would be a 100% engulfing move, would set up the bulls beautifully to get back above the moving averages, get back above this area of prior resistance, which should now be support, get back above that right there and use it to reset the daily uptrend. This, if we do get a retest, the location will be a nice opportunity for a trade as well. Stops go below, and we're targeting the all-time highs, of course, right? So gorgeous trade opportunity on Microsoft, either which way it breaks, in my humble opinion. So hopefully that makes sense for Microsoft. Now let's move into Netflix. So moving into Netflix, guys, down about 0.7% on the day. They just continue their very slow and stable decline, right? Very slow and stable decline on this name. Fundamentals of the business have not been affected too much as of late, and they have really weathered the storm better than a lot of other tech names amidst this sell-off. That being said, we're coming into crucial support, guys, 633 down to about 608, an area of a last line of defense for your bulls. And that is because if we lose this, guys, we really start losing the weekly uptrend, right? Weekly higher lows right here. Lose this area, the weekly uptrend is clearly lost, and we may just be setting up for a potential weekly downtrend or at least some monthly consolidation, right? Similar to what we had after last earnings on Netflix. Monthly bulls still in full control though. Now, Netflix does not have earnings. We need to keep special attention though, guys. It will, as a member of the big tech family, it will be affected by the earnings that come out this week. That being said, if ever we continue our multi-week declines on Netflix, the area that I really like better on the company is anything under 600. If we can get under 600, think 575 down to about 550, down to the lows of last earnings cycle, could be a decent buying opportunity for Netflix. That would put them down at about a 17 to 19% decline, usually a decent buying opportunity for Netflix. We looked at their earnings. Nothing is wrong with the company whatsoever. So that's pretty much everything I had for Netflix. Now, moving into NVIDIA. NVIDIA, guys, this one is going to be one to watch. AMD, of course, ARM, Qualcomm, and now that NVIDIA is in the Magnificent Seven, obviously, if the rest of the Magnificent Seven this week reports poorly, it could have an impact on NVIDIA, even if NVIDIA doesn't operate as direct competitors to them, right? So just be mindful of that for NVIDIA. That being said, daily bears do have full downtrend control right now, getting rejected above us at this support range 119 to 115, using it as resistance, and now the bears looking perhaps to reset into lower lows. That being said, we are in for weekly downtrends right now, into further weekly consolidation and monthly consolidation as well. The overall longer timeframes, guys, are very, very healthy. Monthly higher lows, looking for a continuation of the trend, perhaps later on in the year after some well-deserved consolidation. I mean, also, guys, similar to semiconductors, like how much do you want from NVIDIA, right? NVIDIA literally carried the markets on its back for the last year and a half at this point. So they are allowed to take well-deserved breathers at least for a couple weeks, right? So that being said, NVIDIA, I like the company better down here. 105 all the way down to 95. As close as possible as I can get to this previous zone around 95, that would be a very decent buying opportunity. That would put NVIDIA from the all-time highs down anywhere between 26 to 32%, which has usually been a decent buying opportunity in the company's recent history, right? That one in April was about 24. This one last fall was also about 24. So coming down here would be well within the standard of how far NVIDIA has fell in previous consolidation cycles. So I will be patient with this one and going shopping as we come lower into my green box. As of now, I haven't really added any NVIDIA shares whatsoever. I really want 105 or better all the way down to mid 90s. Now moving into Tesla. So Tesla with a very nice day of recovery today. So very nice right here, 5.6% to the upside, recapturing some of the earnings declines very nicely. That being said, we are still in a daily downtrend. The bull's just looking to create enough space to be able to maybe reset into a daily uptrend, right? So take a look at the size of the bounce right now. Size of the bounce is not too bad, almost coming up to about 50%. We need to see them get at least as high as 240, 241. If we can get at least as high 240, 241, the bulls have a great chance of resetting this daily uptrend and trying to attack our previous high levels. That being said, guys, just be very, very mindful right now of this area of support that we're in. 220 down to 200, right? Huge area. The bulls have been using it very nicely over the past few days. I know I have it extended to about 230. They've been using this downtrending channel line as decent support as well, and the moving averages on the weekly are still below us. So the bulls still do have a lot of short-term support. Even the weekly chart is a nice weekly uptrend. However, in my humble opinion, guys, because of the fact that Tesla didn't give us any short-term, very positive bullish catalysts pointing to margin expansion, so basically margin expansion and revenue expansion, right? Well, I really don't expect the company to do something like this. Everybody would love that, but I just don't think it's feasible for them right now. At best, perhaps we may just be in for some long-form consolidation, maybe between the higher 270, 280s and as low as about 230. That would be the best case scenario for Tesla as it gets through cyclicality, waiting for the first rate cut. This one will probably respond well to rate cuts, but probably more close to that first rate cut date. As I've said prior, guys, I will be looking to play Tesla in terms of short puts, not this week because of big tech earnings and Jerome Powell, but in the future, if I can find some premium anywhere below here, think 215 all the way down to roughly 195, that's where I wouldn't mind playing Tesla. My optimal location, however, has to be below 200. 200 all the way down to 180 is like a very juicy buying opportunity for me on Tesla right now. Now, moving into Palantir, the last one we have for this week. So Palantir does not have earnings this week. They only have earnings pretty much next week. So that'll be interesting as well. That being said, Palantir down a little bit on the day, down 0.37%. Daily uptrend was lost over the last week by the bulls, and now we're just maybe looking for lower high and retest of the lows if overall market conditions do continue selling off. That being said, the bulls have put in a sizable bounce over the past couple of days. Look, 618 bounce looking very good. So the bulls have created enough space to potentially reset into a daily uptrend. Obviously, the rest of the market conditions have to cooperate with Palantir. It can't do it on its own. And then after, if it's not able to make it, guys, may just be looking for the daily downtrend and further weekly consolidation. But that would not be a bad thing, guys. Gorgeous weekly uptrend right now, looking for a weekly higher low and anything above 20.5. Just gonna be looking for that weekly higher low for continuation of the uptrend. This location right down here, guys, pretty much $25, $24 is where I start wanting to be writing a bit of short puts on Palantir if we start pulling back into that area a bit more aggressively. But as of now, the bulls look great on the long term, guys. Monthly, beautiful uptrend right now. Weekly, still a very beautiful uptrend as well, looking for the higher low. Just on the daily, right, that we've lost a little bit of momentum recently, but that's okay. After about 9-10 weeks worth of rally, nice to see Palantir consolidate a little bit before maybe making a second attempt at attacking the ever so challenging $28, $29 area, which was big resistance 2020 and 2021. So pretty much that's everything in terms of our big tech names, guys. Hopefully you enjoyed that. Now let's take a very quick look into my portfolio for a few trades in preparation for this week. All right, guys, so taking a look at the portfolio for the updated positions. We haven't done this one in about a week, so I figured I should give you guys a little bit of an update here. So in terms of our first positions, we got assigned 100 shares of Amazon about 2 Fridays ago at this point at the $190 mark. Now, we do have an average cost about 189.01. And when Amazon had a little bit of a rally last week leading into the first days of the week, let me just pull it up real quick. So when Amazon had a little bit of a rally last week, this was actually last Tuesday coming into the high 189s. I wrote some in the money covered calls on the position just leading into this week of earnings. So as you can see, I wrote covered calls for this pretty much Friday, and we do have a few covered calls. Now, number one, we wrote the 185 covered calls for about $9. Very, very good, right? So even if we get called away at 185 plus $9 is going to be roughly, let's call it 194. So we would be above our average cost by about $5. We would profit about $500 if that is the case. And if ever Amazon ends under 185, these will be worthless, and we just collect $924 in premium. Very, very juicy indeed. So very happy with this one. Now, I do still have the Amazon Leap call, which is also benefiting from a covered call position. You can see we have pretty much some decent gains on this one, and we have the 187.5 calls. Now, this was a rolled position, guys. You might remember that I did have the I think I had the 185s a bit prior. We closed them last week for a fat gain, right? We had these for about $18. We closed them for about $9. We closed $900 in profits, and we rolled pretty much one strike up for about $791. So this one is the same, guys. Whatever happens with Amazon this position, either I'm just going to close this one at a slight loss and ride the leap call, or we close this one at a profit and just ride the leap call. We're just trying to protect our gains. So far, so good. Our average cost now with the premium that I already closed on Amazon covered calls for the leap, this is known what's called as a poor man's covered call as well. So decent strategy if you guys are looking into it. With the premium and with this premium as well, guys, I mean, 900 plus 800. I mean, this option contract value, I mean, our cost will be cut in half. We'll have pocketed roughly $1,500, $1,600 in terms of covered call premium, really helping reduce our average cost on the leap contract, which is why it's always a good proposition, guys, to be writing covered calls against your positions in times of market uncertainty. We did a great job at managing this Amazon position as a whole. Now, I did tell you guys that I started averaging into ASML. So ASML, we do have 4 shares. We picked them up last week at $87.50. I still love ASML, guys, in this lower location right here, right in this green box, right? So I started off very small, 4 shares. I know for a lot of people, 4 shares is a lot, but for the size of my portfolio, it's not too big in this trading account. 4 shares, I'll be looking to maybe double this position if we come down lower into the support range, guys. Think the lower 800s, right? So 800, high 700s, looking for maybe a retest of this region right here if things really get bad in the markets with semiconductors as well. Just looking to add to the position in one of my favorite semiconductor companies as a whole. So just buying the dip, as I've told all you guys to do. You guys can see I'm putting my money where my mouth is. Now, moving on, still have the CrowdStrike position. That hasn't changed. Explained it last week. Just this is a long bull call spread, guys. So looking for just some CrowdStrike appreciation, right? We bought this one pretty much last week towards exactly the same levels as we are right now. Just looking for a little bit of a pop out of daily oversold conditions right now. Just looking for a little bit of weekly rally. I don't care if thereafter it goes down like this, but if we can get above the top end of my strike price right here, if we can get above 280, albeit temporarily, maybe 290, 300, I should be able to get out of this bull call debit spread with a decent profit, maybe a couple $100. Just a little bit of swing trade, guys. John Deere, same concept pretty much. We're in those. Those are for December, so lasting a little bit longer. 400 versus the 410s. They're just slightly above, over all the way up here, right? 400, 410. This is the area that I'm targeting in the larger scheme of things, guys. Just targeting the top end of this range for some potential price expansion with the decreasing interest rates, which is why I gave myself a lot more time on it, right? $10 width of the spread. When we get into them for $4, guys, the maximum profit is $1,000, right? But I'm looking to close these at roughly $800. So we should be making a 2x in simple terms, okay? So moving in, guys, we got assigned some shares of Google last week at 170. We got our cost basis down. Our assigned value, I think, is minus about 25, 30 cents. We wrote them late in the week, so not too much. I wanted Google shares, and I got them. And now we wrote covered calls on the position, got a very decent, juicy covered call premium this morning, 2.79, $279. So now our average cost basis on Google should be closer to around the 167. So looking very good. And I will continue to play Google. If they go down mid 160s, I'll throw another contract down there, looking to ride these ones back to the all-time highs eventually, but wanted at least some protection this week because of the rest of big tech earnings. Now, moving on. Still have a few of our bull put bull put credit spreads, right? So put credit spreads, MasterCard, Metas, a bunch of these expiring this week as well. We'll see how those go, guys. So far, I mean, we're very, very close. MasterCard and Meta, we're very, very close for these either to be worthless or in profit. We'll see how the week ends. I still have my 2 shares of Mercado Libre. Looking to add on Mercado Libre, by the way, only 2 shares. If we do find, they have earnings on Wednesday, by the way, or Thursday, sorry. They have earnings on Thursday. If ever revisit, for any which reason, guys, if we revisit this lower location right here, 1500s, I'm going to buy 2 or 3 more shares. One of my favorite growth companies in the market still. So moving on, Microsoft, as you can see, started buying a little bit of the dip. On Microsoft, we have an average cost right here of about $424. So looking very good on that one right there. And if Microsoft continues to dip in the lower 400s, I will throw 5 more shares at this one in the swing trading account. Not that large of a position, but just want to show you guys I'm starting to buy the dip on my favorite companies that I deem to be in a good location right now. We even have a bull call spread, or a debit spread, debit call spread, however you want to call it, right? 430s versus the 435s for August the 30th. So 1 month of time, didn't pay too much for this one. It's only a $5 width of spread, $226. Max profit on this one, probably looking for about 150, 160, 175 bucks, something like that, okay? Then we also have the Nike. We've had this one for a while, Nike $80 call. Just looking for a bit of mean reversion on Nike. If we can get a pop back towards the $77, $78, should be fairly decent. We bought this one when Nike was about 73. So far, it's still down just because it's been time decaying for the last 3-4 24 weeks at this point. Still have the shares of OXY that we got assigned at $64. They're now down, no covered call spread on them just yet. And then we have a bunch of plays that we took for earnings, right? So we'll go through these earnings plays very, very rapidly. So Pfizer's 27.5, guys, always 2 times the expected move. You guys know my earnings strategy. Pfizer 27.5s is about 2 times the expected move. That would be a drop of roughly 10%. The expected move on Pfizer, I'll put it up for you guys right away. So just so you guys can understand the strategy, right? So Pfizer, we're looking for 2 times the expected move. Expected move, 4.5%. We're going about 10% below. And where is 2750? Is it in a nice area of support? Well, I don't know, guys. You tell me, right? So I try to line up the nice weekly support levels right down there with 2 times the expected move. If both criteria are respected, then I take the trade. So that's why you can see right here, we have 2 contracts. We only got 6 cents for them, guys, but it's still something, right? As a whole, we would be looking on a weekly basis on Pfizer about 14 cents. This is for 1 day of trading. I'm closing these tomorrow regardless, right? So on a weekly basis, this premium would be about 25 cents. So it is within our minimums. The next one, Procter & Gamble, 157.5s. Same logic applies, guys. 157.5s on Procter & Gamble. Where is 157.5? Let's just go ahead and put a box right there. You guys can see 157.5. Is it a very decent first range of support for the stock? I don't know, guys. You tell me where that 157.5 starts. Does it look like a decent location for you? I definitely think so, right? That's a drop of roughly, about 7% all the way down to potentially being assigned on Procter & Gamble. Procter & Gamble should do very well in this market in this market condition right now. 4.5% expected move. So we're not quite a double, but then again, there was no premium below this strike, guys. Below 155s, there was like no premium at all. We only got 11 cents minus commission. It might seem like nothing, but on a weekly basis, this would be about 50 cents. Still under our required minimums, but we're only in this one for 1 day, guys. I'm just looking to stack a little bit of pocket money here, playing these earnings, as many of them as I can, and just looking to just pile on, right? $20, $30, $15 doesn't appear like much, but when you do it 10, 12 times a week, guys, that adds up to several hundreds of dollars in premium per week, and very, very, risk averse levels on very solid companies, right? I'm not playing consumer discretionary ones anymore. I've learned my lesson for this year as a whole. I've tried to give them a chance over and over, guys, but unfortunately, they just still out of favor. I've been trying to time that recovery cycle, and so far it appears as though I'm about 1/4 off. So that's just the way it goes sometimes. PayPal. Now we do have some PayPal $50 puts, 14 cents for those. So PayPal, same logic, guys. PayPal, the $50 level is the lowest point we ever hit last fall. So I'm counting on that last level of support really to back me up. And that from 58 right now all the way down to 50 would be about a 15, 16% decline. Take a look at the expected move on PayPal for the week and you will see why. So PayPal, just going to go through this one quickly. The expected move on PayPal should be about 7, 8%. I don't know why it's not loading right now. Let me just refresh it. Let's see if it kicks in. All right, beautiful. So PayPal right now, you can see expected move 7.5%. So we're literally 2 standard deviations at the last line of defense right down there. And the valuation of PayPal, if PayPal gets to 50 or lower, guys, I'm literally going to keep it. At 67, the peg was almost at a 1. At 50, it's going to be well below 1. I'm just going to keep the shares if we ever get down to 50, guys. So not too worried about that one. We also have some call options. I took a little bit of a gamble on this one just because PayPal has been significantly crushed. I think that the outsized move can potentially be to the upside just because they've been down for so long, guys, right? It serves me no purpose going in with puts at such low levels. I think if ever there's some outperformance, it may be to the upside. So I'm taking a gamble on it. October, we're literally 3 months out in the future, 81, 82 days out, $65 calls, not too much further than where we are right now for about $2.10. We will see how those go. SoFi, we're into SoFi as well. So SoFi, you can see I have a combination of the $6 and the $6.50 puts, right? Same logic applies, guys. I'm not going to go through these individually, but you can understand 2 standard deviations and in a very big level of support. So that is the move I'm looking to take on SoFi. SoFi, $6.50, $6 at the lower end of the past 6 to 9 months of support. That's why I like it down there. 3 contracts each. If ever it drops after earnings, I may add a little bit more. We'll see how it goes. We also went the other way with SoFi. We went the $5 in the money calls just because the premium was so good, guys. $5 calls and they're $2.50. The stock price is $7.33 right now, which tells me that there's literally only 19 cents of extrinsic value in the stock, right? Of options premium. That is nothing. From $7.33, where we are right now, to $7.50, you're paying a 2% premium for call options, right? very juicy proposition because we know SoFi can have some blowout quarters sometimes. If ever they do have a blowout quarter, these calls should be fairly good. If not, we're risking $250 and we do have about 3 months worth of time. Symbiotic, I also took some plays off of those. $26, $25 puts. We'll see how it goes. Symbiotic dropped a lot, but still we went 2 times the expected move on those. Symbiotic right now in the after hours, if I can pull it up, let's just see right here. Let me turn on the after hours trading. So after hours trading, we're down to about 28.77. We didn't have a very good day at all. Down 8% on the day. And in the after hours, you can see right here, down 19%, but we are still significantly lower than that, guys. We're at 26 and 25. We are an additional 9 and 12% away. So we'll see how this goes. But the reason I took those levels, guys, is because pretty much our last level of defense all the way down here. These would be pretty much May 2023 prices, better than anybody has gotten in the last year of trading. So that's why I like this one. I would give it a chance down here. And as you guys saw, not that large of a position at all. 25 and 26, only about $5,000 worth of exposure. How bad can it really get, right? And then we went with one of the trades that I had yesterday in the top 5 options plays, the TSM 152 puts. The logic was in yesterday's video. We got about 86 cents for them. Not the best pricing that I could have got during the day, but fairly happy with it. Respects our 0.5% minimum and is still a decent ways away from the current share price right now. So TSMC, I like this one, lower 152 levels. So that's exactly where I'm targeting. That would require a decline of about 5% for us to be assigned. So looking forward to see how that one plays out. I opened the UPS calls as I showed you guys last week, 130 calls for October, about 90 days left on that one for about $5. So far, we opened them right around the same price right now, guys, about $127. So if UPS has a little bit of a pop after getting destroyed on earnings and being relatively daily oversold, if we do get somewhat of a little bit of a pop back into maybe the mid 130s, this call option should do fairly well. So just looking for a little bit of swing trade on that one. I have some Visa swing shares as well, as you can see down here. And we do still have that Visa bull put credit spread for this week too. So Visa, I continue to be a fan of this one. If for some which reason MasterCard drops after earnings, I will be looking to play Visa for some short puts down here, lower 250s, or maybe even acquire some shares of Visa or MasterCard, depending which one drops the most. That is pretty much everything for the portfolio right now. You guys can see I really, even though there appears to be a large amount of positions up here, in terms of the size of the positions that I'm holding, guys, they're really not that large at all, right? I still have roughly half of the account for buying power just for this week. So the rest of earnings that I'll be playing this week, guys, I'm not too sure, but I'll be playing AMD. If I can find some premium in the 120s, maybe playing AMD. Microsoft, I probably will be playing. I'm not touching Starbucks at all. Learned my lesson on that one last week. Even though this quarter they may well rise, I'm still not playing it, guys, right? And then Wednesday, I'll probably be playing Meta. I'll be playing ARM. I really have to get a very good level for me to play ARM. So just the ones I'll go for you guys for tomorrow, obviously, because tomorrow we're not going to be able to see the rest of the positions, right? So I'm giving you guys which ones I'll play for tomorrow because we won't be here. And then in tomorrow's video, I'll tell you guys how I'm playing the rest, okay? And we'll do this one day at a time because if not, it's too much. So for tomorrow, the ones I'm playing after the close, probably AMD, probably Microsoft. ANET, I'm not too sure. Let me just check it out. Yeah, it's kind of a little bit too high for me right now, guys. Don't really want to put, I mean, you know, to get decent value, you'd probably have to go all the way down here. Maybe you 260, 250, but still that's $25,000 worth of buying power. Not too sure I want to allocate that amount of buying power for this company right here. I'd rather save it for Amazon and Apple, to be quite honest with you. So not too sure I'm going to be playing that one, but AMD and Microsoft definitely for tomorrow, guys. First Solar, probably not. Waiting for after. Caesars, probably not. EA, probably not either. And then before the open, MasterCard's a little bit too expensive to be writing short puts. So I'll be waiting for after, maybe just looking for long call options or debit spreads. Generac, you might be playing it. Altria has run a lot, even though I love the company, guys. It's just run too much for me to be playing some short puts. And usually you don't find much premium to be had at all in this lower location right there. So that's pretty much everything, guys. So for tomorrow, so we'll cover the rest tomorrow after the close. Sorry for keeping you guys a little bit longer. Hopefully you guys enjoyed today's video, guys. If you did, consider dropping a like and also consider subscribing to the channel. If you're new here, would appreciate both of those for the growth of the channel and would obviously love to see you back with us. And as usual, if you have any questions at all, guys, especially in these very tepid market conditions right now, if you have any questions whatsoever, stock selection, technical analysis, options play, macro discussion, anything you want, leave it down below in the comments and I'll get back to you usually within the first 24 hours. Take care. Happy trading tomorrow. I'll see you after the close and peace.